In this video, we will discuss Section 12J and the allowance granted for investment in venture capital companies. I'll ask Megan to just briefly give us an introduction to Section 12J, and then we'll take the discussion further.
So Section 12J was brought into the Income Tax Act to encourage investors to invest into small companies and small businesses that's struggling to get capital. It was enacted in 2008, and it allows investors a allowance or a deduction of the full investment made into those companies. The allowance is available from day one, and going forward the legislation will change which caps the allowance now available.
Megan, how does that, the deduction that the investor gets, why is it so beneficial? Is there any, apart from investing in for example, listed shares, why is it more beneficial for an investor to invest in a venture capital company than to merely buy listed shares on a stock exchange? Is there any beneficial tax treatment for them?
Obviously, if you're investing in a listed company, your investment into that company is not deductible for tax purposes, whereas a investment in a venture capital company is allowed as a deduction. You get the full deduction.
Bertus, if you can perhaps just briefly discuss the requirements that will allow the deduction.
Yeah, so part of the policy, is really reflected in the deduction. What it is, what it aims to achieve is to develop almost a fund. It's not a fund as a mysterious creature. It's in essence a company registered with the Financial Services Conduct Authority that aims to pool a number of investors' funds into this single company with the sole aim to invest and maintain investments into so-called qualifying companies that engage in, that have a certain shareholding structure, engage in certain trades and not in other trades. It is supposed to act almost as an angel investor. It is supposed, through a tax deduction, to incentivize the public to reinvest passive capital into active capital and ventures. So typically, you'd have an entrepreneur with an idea but without capital approaching one of these venture capital funds and say, I've got an idea, you've got capital, let's pool together into a qualifying company investment and see whether we can grow the economy and grow jobs. So that's the incentive behind it. And for that reason, it is aimed at the broader public, so no investor may own with or without connected persons more than 20% of the shares in the venture capital company. So you really have a bouquet of investors at the top. Similarly, the venture capital company cannot invest into one anchor investment. It needs therefore to have a bouquet of investments at the bottom, qualifying companies. And to top our spider up, these investors at the top into the venture capital company with the investments at the bottom, these investments at the bottom must be held at least 30% by an outside shareholder. In the policy-driven perspective at least, it is the entrepreneur that would hold at least the 30% or more shares in the qualifying company.
In considering the requirements, one of them as well is that the certain trades are sort of called impermissible trades. Peter, if you can perhaps elaborate on that for us a bit more.
Yeah, but there are various impermissible trades that the qualifying companies are not allowed to partake in. The default position is actually that a company will not be considered a qualifying company if they do undertake those impermissible trades. There are various, as I mentioned, various trades that aren't allowed, one of them being any trade in tobacco or alcohol. But one of the more interesting ones that we've seen come over now recently is where sort of the Airbnb model is followed by many venture capital companies. Now, why that's interesting is because one of the impermissible trades is any trade carried on in respect of immovable property. So ordinary rental situation where you have a property which you merely rent out to a tenant, that would be a trade that's carried on in respect of immovable property. Which would then not qualify as a permissible trade. However, to the degree that the trade is carried on as a hotel keeper, that trade on the immovable property will not be regarded as an impermissible trade. So the concept of hotel keeper comes into play when considering whether a trade is in respect of a hotel keeper or not. Now, the Income Tax Act is very clear on a definition of what a hotel keeper is. one of the main concepts as part of that is that sleeping accommodation must be provided, which is generally not a problem in the Airbnb model. But where there is often a discrepancy or a misunderstanding is that meals must also be supplied as part of that service offering by the lessee by the lessor at least, to qualify as hotel keeper. And that makes it very difficult to determine what this concept of the providing of meals is for the persons. And it's, unfortunately, it's very fact specific. You cannot say if you have an Airbnb model and you provide pre-cooked meals as part of your service offering, or you have a food delivery company delivering food to the specific person on order, or if you give them vouchers to visit a restaurant, whether that would qualify as the supply of meals as part of this service offering. So what we've seen many venture capital companies do is actually, on a fact-specific basis, approach the South African Revenue Service to obtain a binding private ruling to give them an indication whether their specific facts and circumstances would qualify them as operating as hotel keepers. Because the sleeping accommodation, the providing of sleeping accommodation as part of that is generally not ideal. It's all about this concept of the provision of meals. It might sound like a very negligible point or very small technical point on which all of this hinges, but if the venture capital company's main focus is immovable property that they want to carry on as a hotel keeper, the whole structure, the whole VCC model can stand or fall by this concept of whether they are a hotel keeper, and that in turn can be determined by whether they are actually providing meals as part of this service offering. So despite the fact that it seems like a technical or matter that's not really relevant for consideration, it could influence the whole venture capital model.
Yeah, look, Peter, you say it's a small technical point, but of course it comes down to abuse of legislation. The allure of using immovable property as a hotel keeper is that you reduce the commercial risk of the underlying investment.
Absolutely.
It's not like investing into an IT business. I'm investing into a building on a piece of land in Cape Town CBD. I mean, quite clearly the risk profile of the latter business is significantly reduced compared to an IT startup. So that's why I think a lot of taxpayers are trying to sail close to the wind. And I'm confronted with a question quite often by clients to say that, yeah, they're going to close down the VCC regime. We know the sunset clause is 30 June 2021. My own suspicion is that it's going to be pushed out somewhat. My own interpretation of policy at this stage is that rather, in practice, we're going to see a clampdown on these so-called hotel keepers. People really misusing or abusing the idea behind what a hotel keeper is. So I think you need to have your rooms cleaned on a regular basis. You cannot have only spaghetti and rusks and bread in the cupboard. There needs to be meals provided, as you said. A third one, which I see quite often now, is that Treasury brought out a discussion paper a year or two ago, in which they say that you've mentioned one of the impermissible trades is that you cannot carry on a trade linked to the provision of alcohol, for example. And they say that hotels selling alcoholic beverages will not qualify. I think that is an extremely conservative viewpoint from SARS, and I'd be interested to see whether a court would agree with it. My own views are not. But in approaching this almost anomaly really in practice, I've seen that a number of companies remove their liquor license from the VCC structure and have it in a separate company. So of course all these things I think are able to be structured around. The important thing though is to approach it with caution and to be sure that if, especially in the hotel keeping industry, you ensure that you are within the spirit of providing employment and developing the South African economy.
I agree with you, talking about the spirit of the piece of legislation, because at the end of the day it remains venture capital. The capital should be on risk and the capital should be actively put to use, whereas if you're merely investing as part of immovable property, that's not the case.
Earlier this year, Treasury has issued some amendments to the Section 12J legislation. Albertus, can you perhaps just take us through some of those amendments and also talk a bit about the effective date of those amendments?
Yes, so Megan mentioned the one initially. and it's caused a major uproar in industry, is to say that, well, it's actually to reintroduce an old concept. When the 2008 legislation was introduced initially, there was not a significant amount of uptake. We saw very few VCCs being registered. Initially, one of the negatives to the legislation was a so-called investment cap, to say that your investment deduction is capped at 750,000 Rand per year and at 2.25 million over your lifetime. That's since been left out or removed from 12J in order to increase the allure of the incentive at least. Now it's been brought back. I think Treasury has said that we've seen enough VCC investments and we want to cap the investments of especially high net worth individuals. So VCC deduction will now be capped at 2.5 million Rand. So that's the first significant one. The second one is that a qualifying company may never, not even from day one, be a group of companies in relation to the VCC. In other words, if a VCC is going to set up a structure with qualifying companies, it cannot incorporate the qualifying companies, as it will then, for a moment in time, be the only shareholder in that company, thereby rendering it a group of companies, in other words, holding more than 70%. The effective date of these proposed amendments, of course, we expect the final bill to be enacted shortly, is the date of promulgation of the draft bill itself, which was on 21 July of this year.
In tying into one of the amendments that you discussed, the cap on the allowance, one of the challenges with that, the practical challenges, is that you in some of these structures already have investors that invested under the current legislation where there is no particular cap. And now if you want to introduce new investors, you have this challenge on the shareholding and the percentage held by new investors coming in. And we had equal partners, and I put my money in the day before the draft bill was issued, and you only put your money in the day following that, and now all of a sudden we have shareholding that's not aligned to our discussion that we had previously. So that's one of the things that we'll keep our eye on and see what Treasury does with the amendments towards the end of the year. We're expecting the final amendments to come out later this month in October, and the final Amendment Act to be promulgated late December and early January. And then following all of those issues, we'll keep everyone up to date and give a press release out just indicating what the new tax laws would state around Section 12J, and we'll just keep our clients up to date.